So no getting around it. This is longer than normal. We're talking long game with Lior Gantz, and a long game deserves a long talk. I don't publish 30-minute videos. I just don't know how to keep something like that interesting, but this one's different, and I just didn't know where to cut. Now, there are four main topics here. We have factors in gold's rally, of course, and then we have silver's potential run, how part of that might line up with the story people typically promote. But the nuance here is a really big one. Then we have silver versus gold, and we end with where we're at in the overall rally curve. Now, you feel free to jump around. There are parts here, though, that I think might surprise you in an interesting way. So if you have the time, I think it's worth it. So let's just get into it. Lior, happy to have you today. Good to see you.
Good to see you too.
I think we start with gold price. We're just talking about it. Impressive rally. It's up, what, 24% on the year. If we go from the all-time high, we started the year January $2,040. So no real surprise other than the fact that it kicked off about 10 months before really there was any evidence of a rate cut. So three obvious factors. You've got central bank demand, you've got Fed policy pivot, and then you've got regional conflicts. So I think that it makes sense on how we've gotten to where we are right now, even if it's a little bit early, but I feel like there's more to it. And I feel like there's a big question of where it goes, what keeps the rally going.
Yeah. You know, for me, the gold rally is about the role of the dollar in the era that we're entering into. And as you can see, China and the United States are not able to cooperate. The age that you saw with President Clinton bringing China into the WTO, and trying to make sure that China is some part of this global framework that is led by America. Everybody enjoys it because America is open to the rest of the world. Your markets are open. You patrol the seas, etc. That era is over. And in that era, the Chinese had to buy a lot of dollars. All countries had to buy a lot of dollars. 58% of the world's transactions are happening in dollars, right? Down from 71% in the turn of the century, but still, you're talking about a major percentage. But what I think is happening right now is that uh, the world is coalescing. What the war in China, I'm sorry, in Russia and Ukraine proves is that a powerhouse, an industrial powerhouse like Russia, which can also send hundreds of thousands of troops to their deaths, and their society does not crumble. They believe in that doctrine of that's how they won all of their wars, sending troops until the other side just cannot do it like they can. And you're seeing that President Putin has to go to Iran and kiss the Quran in order to get more drones against a country that's less than half of its size and has infiltrated his domain. And not only that is Ukraine now in his territory, but it's also able with drones that you can buy on Walmart to take down warships and bridges. So in this world, every country needs other countries in order to fight its wars. Another case in point is that right now what's happening here in Israel. In order to stave off the attack in April by Iran, which was thousands of drones, missiles, etc., we coalesced with the British, with the Americans. We had to use airspace of the Jordanese, of the Emirates, of the Saudis. These coalitions tell you that America is moving away from being this mothership for everyone else and is strategically looking to be parts of these coalitions that are more regional. And if you have regional coalitions in the world, you don't need the dollar as reserve currency. So to me, the natural place for the dollar is to keep being the most dominant currency in the world, but more alike it's the size of the economy that it backs. So the US is about 26% of the world's economy, not 58%. And that's where I think the dollar is going over time. It's going to be used in 26 to 30% of the world's transactions. And that is a huge drop from where it is today. So the dollar is already trading as we do this interview August 27th at a 2024 low. And if you look at big signs, look for October 2022, which was the peak for the DXY index at 111 points. It's now at 100 points, so it's down over 11 points, which is around 10% from the high. It's in a bear market, and correspondingly, look at the GDXJ, so the gold mining index from October 2022 till today. It's up 95%, literally correlating with the dollar bear market. So you have a dollar bear market, a gold bull market, and gold an all-time high. What you didn't have in the first 2 years of this, so between October 2022 and today, which is 2 years later, what you didn't have is you didn't have rate cuts. And now the rate cuts are coming. And if you want to, I really want to dive into the differences between the July FOMC meeting and what Powell said and the Jackson Hole one. But in 3 weeks from now, the Fed is cutting rates, and that means that from my perspective, the dollar is gonna keep going down from the DXY 100 right now. It's probably gonna end the year at 98 or 95 even on a worst case scenario, but it's going down. It's going down towards the 85, and who knows, maybe even lower. And I think in that context of a dollar bear market, silver has a lot more to go up, and the mining stocks have a lot more to go up. We are in an era that is very favorable to precious metals. Couple that with the USD to JPY carry trade that's ending. And what is that carry trade? That carry trade is a sign of the era. From 1991 until today, for the last 33 years, it's been very easy to hedge your holdings with a long US dollar, short Japanese yen trade, because the Japanese kept deflating, and they wanted to stave that off with inflation, so they kept debasing the yen as opposed to the dollar. And what the BOJ, the Bank of Japan, just did with raising interest rates ends that. So think about all that dollars that are long and will have to be sold. These are sovereign wealth funds, governments, pension funds, endowments, all selling the same carry trade. At the same time, and I know I'm being long here, but just to finish this thought, there is $6.24 trillion in money market accounts in the United States alone, yielding about 4.5% to 5%. As the yields start to come down, that money is going to exit. Not everything, but even $1 trillion or 2 or 3 that are headed to a different direction, like housing, stocks, and commodities, is going to have a huge impact. So I think that you are ending a very big cash bubble that has been accumulating for the last 5 years. And the dollar bull market, if you look at it, it started April 2008 and ran for 14 years on the DXY, for 14 years from the bottom. So think about that. We're only 2 years into the bear market.
There's a little bit going on there that I think we want to go further on. One, you mentioned silver, and silver to me is an interesting one because you have the industrial use, you have the investing side, and the investing side just is not what a lot of people think that it is. It's commodity driven by industrial use, and when you've talked in the past about how silver is more directly related to dollar performance, I think I want to hear a little bit more about that, because there's this idea that gold being near its all-time high, that kind of limits its potential for upside. So less upside when you get near the all-time high. Silver is nowhere near it. Silver is still below $30. It's had a nominal high of 50, but things have really changed for silver over the years in the industrial use. We've seen it over and over and over and over where it just keeps under that number, gets kept down. What would change that?
There is a big correlation inversely between the dollar's performance and silver's performance. The dollar really is or silver really is a derivative of dollar weakness. And as you've seen in the last 2 years, we are in a bear market for the dollar. That bear market, when it started, silver was 18. It's now 30. So while the dollar has gone down by 10%, silver has gone up by about 60%. If you extrapolate from that, and I think you should, another 10 points down for the dollar, which is 10%, and think about another 60% from where we are, we're going to 48. And if, like I think, we're going down by about 15 to 20% for the US dollar by between now and about 2027, 2028, then I think that what we're talking about is silver between 50 and 70 an ounce, all related to dollar weakness. So yeah, to me, silver is a story that is just getting started. From the industrial uses side, the amount of silver in most industrial components, it's in thousands and thousands of products, is very minimal. So if you have to buy your silver for 30 or 40, 50 or 60, it makes very little difference to your bottom line, or to the price of the consumer. Just so you understand like what I'm talking about, in a loaf of bread that costs $1.50, the wheat component is 10 cents. So when you think about an iPhone with its few grams of silver, you're talking about something that has very little, if anything, to do with the price at the end. And so I think that the industrial component of it is not what's really gonna keep a lid on it. It's gonna be the dollar's weakness coupled with how fast new mines can come into production. Keep in mind, silver is mostly a byproduct and not a primary metal in most mines, and therefore normally you do not see a lot of silver coming, new silver coming to the market. What normally ends silver bull markets, which we are on, is mania, and I don't think we're in mania right now. If we were in mania, you would be asking me a different question. You would be asking me, are you buying 100 ounces, 200? How much are you buying before this thing goes to 50? Clearly, you're not asking that, and you're a good barometer. So we're nowhere near where we should be in terms of the price of silver, and I see a lot of upside. And in fact, I wrote a special report just about that topic and about the coming rate cuts and how important they are for the price of silver at wealthresearchgroup.com/cut, as in CUT, cut 2024. If you download that, spend 10 minutes reading it, you'll understand exactly what can happen as we start to cut rates.
Okay, so I don't want to go too much further on silver, but just to maybe segue it back to the wider market, I think I'd like to open that up a little bit, partially because with silver, it's one of those cases where the little boy has cried wolf so many times for silver, and there's never been a wolf. Is the case for silver industrial use? And we just talked about this, and I know you got into it, but I want to just put a finer point on it. Or is it investment? I don't know. Do people invest in silver in large scale?
The answer is that all of these debates happen every time that there is a silver bull market. If you look at all the silver bull markets in the fiat monetary system, they all look like a big nothing until they happen. And so the case of the boy that cried wolf is every time. But then there's a very short period of time. It could be a year, it could be a year and a half, and that metal goes on a tear. It just flies on its own. And you can then debate what it caused it, why it's doing what it's doing, anything you want. The most important thing is that you be part of that ride. And then when that ride ends, you need to leave, because silver is going to go down by 50 to 60 to 70% after that and enter a bear market. It's always the case. Look at every time that it's moving. Now, what is the difference between now and basically 2011 until today. Between 2011 and today, everything was happening in the context of a dollar bull market, especially 2014 onwards, when the real breakout started to occur in the price of the dollar. So if you look at that in the context of we were in a dollar bull market this entire time, and now you understand that for the last 2 years we've been in the dollar bear market. It's down 10%. Silver's up 60%. Then you start to say, okay, my thesis of, hey, the government's printing too much, deficits, the whole thing. My thesis was right, but the effects of my thesis were premature. I acted on the thesis and not on the fundamentals of the trade. The fundamentals is wait until the dollar is in a bear market. So the dollar's in a bear market for 2 years now. I think that this dollar bear market is going to be an average of 8 years, which is what it's been throughout the life of the modern US dollar, and that means we have 4 to 6 more years of this. And to me, the boy that cried wolf, that's a sign of the times that nobody believes in it because everybody was way too early by years and years. The best trade of the past decade was big tech. We don't have to really debate it. The NASDAQ has been returning 15% a year since 2008. 15% a year. No hedge fund in the world has been returning 15%. Warren Buffett became the richest guy in the world with 19.7%. You're talking about an insane performance for just buying and holding the NASDAQ, right? So that's been clearly the best trade. With a dollar bear market, that will not be the best trade. With a weak dollar, big tech suffers because we're inflating, we're not deflating. It acts against growth companies and in favor of anything that's priced in the now. And what's priced in the now is value. It's small cap, so Russell 2000 or Wilshire 5000, and commodities. And that is really good for silver.
Yeah, you said a couple of things that I think are important.
Thank you.
So with silver, I think that there's this, there's a draw to it for a lot of reasons. Part of it's just the unit price. Now, if we're talking about physical, it has a great entry cost. It's easy to get into, it's fun. If
Absolutely.
we're talking about physical still, and we look at a price run, a run up to $48, one of the things that you mentioned was the drop. So we've seen, there aren't a lot of cases where we can see a big run up in silver. You see it in the 80s, and we know what caused that. We see it in 2011 and
in the 70s.
Yeah, right. So Hunt Brothers. So we saw what happened right after that spike. We saw it happen in 2011. Actually, in 2012 is when it started to drop. So I wonder a little bit about the form of silver. When you say silver, and we're talking about investment, there are a lot of people who buy silver, the physical metal, stack it up, and they think, okay, someday it's going to tear off, and we're all going to be rich. So when you say silver and you look at it as an investment, what form are you talking about?
Look, to me, silver has always been a trade. My preferred form of saving, outside of standards, so outside of the normal ones, the alternatives, my favorite one is gold. Gold compounds at around 7% a year. That's almost like the S&P 500. That is a really good compounder and a saver of my wealth over time. There's no doubt that gold has outperformed silver by a lot in the past 51 years, certainly within the century. So to me, that's always the preferred. Now, in clear cases of a dollar bear market, when the gold-silver ratio is this big, where it's over 80, and to go back to some sort of a median, it has to go to 60 or 65 or 55 with the ratio. And I still think that gold has higher to go. To me, the case for silver to go from 30 to 50 is big. Now, 30 to 50 is not a lot. That's not even a double. So I don't do silver. I don't do physical silver uh, almost at all. My gold hedge is 2 years of my lifestyle burn rate converted into physical gold. So if my family uh, um, spending habits is, just to round this up, is $5,000 a month times 24, that's 120K. That's in physical gold. That has always been um, my hedge. With silver, I like everything that has to do with the silver space, except for the physical metal. I don't need the physical metal. I have gold. For the physical, I have gold. If I am looking to uh, win from this move from 30 to 50 in silver, I am going for the silver leverage. I'm going for the options. I'm going for the silver miners. I'm going for the gold companies. That's where you'll see 2, 3, 4, 5, 600% returns in 2 months. I'm sorry, 2 years. You'll see that. Why would you deal with the silver, with the metal? It makes no sense. If you're a big hedge fund and you're looking for exposure to commodities, fine. But if you're an average person and you're putting, I don't know, 1,500, 2,000, 10,000 in silver as a speculation, why would you go with the physical? You would go to where in the next 2 years you can really get some asymmetric returns. That's my opinion, and that's what I've done. I'll give you the perfect example. In 2009, I was sure about silver, and I was a kid. I was 25, yeah, 25, 2009, and and I put a few $1,000s in silver, sold at 44, bought it at 15, sold at 44, and funded like the extra 2 weeks of my honeymoon in 2011.
That's
That's
great.
it. I know, but it's nothing, right? In the big picture, it's
Hmm.
nothing. At the same time, I was already compiling a watch list of the best silver companies in the world. And those companies, at the same time as silver went from 15 to 44, they went from 3 to 30, 2 to 25, $1 to $18. And so the question is, if they're both going to suffer the same fate, where afterwards they're going to crash back down, where is it better to put the money? Is there such a big risk involved with the miners that you can't afford it, or that you can't afford to diversify between the few of them? My answer is no, because I see those companies are still around. So if you've been in business for 14 years or 15 years, um, you obviously are a very talented mining company, and good at operations. So the next silver bull market, which is now, um, my attention will be towards these. And silver, I'll leave it for the pension funds, for the hedge funds, for the investment banks. I don't need that. I can go with the smaller ones, where some of these big ones may not even be able to take a position because they'll move the entire market.
I was trying not to lead us there. I was trying to see if you would take us there without me saying anything, because I get a lot of comments from people who I think misunderstand my thoughts on silver. I think people get the impression that because I favor gold in terms of physical asset, people think I don't like silver. Well, I like silver as a trade, and you said that exact same thing, silver as a trade.
Yeah,
I think,
to me, it's a trade.
well, we're probably getting into trouble here because the villagers, I'm sure, are lighting their torches and they're about to come after us here, because a lot of people see silver two ways. The one story is that silver has this huge opportunity, and I guess what you just said lines up with that. But the other is that you need to hold it for the long game, not consider it a trade, which really means that you miss the opportunity in a spike because you can't have your cake and eat it too. You can't take advantage of the upside of silver if you're thinking about it as a physical asset that you want to just stock. That to me is a really strange case where you also said you don't need the physical silver because you have the physical gold. Well, I would say maybe you want to have a little bit of physical silver. I have a little bit. I kind of like to have that. But there's a point where I got out in 2020 of physical silver because of the premiums and moved into ETFs and other derivatives. And I think that at some point is going to, pay off. I think now that makes sense. But I see a lot of people who are out there talking about the gold to silver ratio, and that just works like this. Go buy a bunch of silver because gold's too expensive right now. That ratio comes down, convert it all to gold because gold's where you want to be. Where you're losing a lot of premium. And in a case where silver does spike to $48 like it did in 2011, that happened so fast. The case for local coin shops being able to convert all of that for you, it's pretty unlikely. I don't know. Do you have thoughts there on silver as an alternative to gold? Do you think they're totally different things? What do you think?
Well, they're certainly different, right? Because gold is a tier one asset defined by the Bank of International Settlements. So literally, if I'm a big money guy, if I'm managing billions for a university, for a government, for a pension fund, I have a tier one asset. A tier one asset, I get 100% collateral on it. Think about like Persian Gulf countries, the Asians, the Russians. Silver means nothing compared to that. So silver is important for retail folks in the United States, perhaps in a few other countries like India and China. But gold is the big market. Gold is the mothership, and silver is like the little dinghy that runs around the mothership, like the lifeboat. The lure is that you have this ratio that's biblical of the 12 to 1 because it's written in the Bible. Then you have the Middle Ages one where it's 60 to 1. Then you had like classical ones where it was like 20 to 1 or something like that. But uh what other decision do you make in life? Because it used to be that way thousands of years ago. I just don't. I'm not there. Um, what will take it to 12 to 1? What will? What capacity will silver trade for a 12th of 2,500, which is $200? Why would it go there? It takes about $15 to or $60 to make it worldwide to produce it.
Yep.
I just don't see it.
Yeah, I don't either. I just wanted to get your take without me trying to pull an answer out of it that lines up with what I'm thinking. Clarification, I suppose, here would be that we're not talking about stacking silver to the ceiling and ignoring gold, using it as some kind of hedge for the end of the world or the dollar or whatever. But that seems to be the advice around here, not using it as a trade.
If the US dollar goes to zero, that's because the world is ended. Um, it's more likely that what I just said will happen. That it will go towards the 2008 lows. That was a pretty weak point for your country. Would you not agree?
Yeah, it was pretty bad.
Okay, the DXY was 72. So that's 28% below where it is today. That to me is very reasonable in a scenario where we are headed to like a very steep bear market. But that's it,
Yeah.
28% down. I
Okay.
mean, fine. If you have $1 million, that's
Yeah,
that's
you'll
a
take
problem
it.
because you I know but I'm saying if you have $1 million saved up for retirement
You're
and you're
talking
like, oh my
cash.
God, Lear's just saying that in 5 to 6 years from now, the purchasing power of it will be 720,000. Man, I'm losing 280,000 dollars of net. That's a lot. I need to do something with that. But that is the extent of it. That's it. That's your worst case scenario that you have to prepare for. The currency crisis is not the biggest crisis. It's just not. There are much bigger problems that if you think about it, and you want to prepare for. So yeah, that's what I would definitely say. Like you know, it. I hedge against the dollar. I have very little sitting around in straight cash because it just doesn't make sense, right? But most of it is in either in gold or in investments, and the silver story is a trade. Every time I see the move, I do use it, but as a trade.
Okay. I think we spent a lot of time on silver. I just
Yeah,
really, really quickly, the
sure.
relevancy for gold going forward, other nations buying it, holding it, central banks buying it, the demand. It seems like there's a lot going on with gold where it's in the news a lot more than it used to be. It seems more relevant than it used to be. And I think that a lot of that comes from Eastern nations buying it. Is that a safe feeling? Is that something that you agree with, that gold's relevance keeps on? Is it something that is going to be usurped by Bitcoin? Is it going to stay top of mind? What do you think when the rally comes in and hits for real? Say September, we see it actually kick off and not be a hope rally anymore. How long do you think that that lasts?
I mean, here are three things that are very important about gold, right? You had the 1970s bull market was fueled by an entire change in the monetary system. That took gold up by 2,400%. That was one case. Then the second case is the 2000 to 2011. It went from 250 to around 1900. That's 7 times your money. Okay. And then the new bull market started basically in December of 2015 at 1,100, but it actually bottomed again at 1,200 in September 2018, and we've doubled. So in this bull market, we've doubled. That is a very early stage bull market for gold. And we're not a new financial system, but we're definitely redefining the role of the dollar. And it's coming down. Like it started at 71%. It's now 58% in this century. And it's going to go down further. So the case for gold is alive and well. I do think that it's going higher. This is not what a top for a gold bull market looks like at all. I saw the top in 2011. It's daily news, daily articles. It's CNBC front, front and center. It's gurus that are coming out of the woodworks talking about gold. You're not there. You're nowhere near there. So yeah, I would say you're nowhere near there. There's more. There's more upside. I don't know if it's going to 3,000, 4,000. I don't care about the price. I will assess the end of the bull market by the mania. That's the best way to assess the bull market.
I think that's a good point. And also a good place to end. So, Lior, thank you so much for everything here.
Absolutely.
I'll get the link to the Cut 2024. Anything else we want to cover before we go?
Like I said, if you want to check out my portfolio, you can as well. It's at wealthresearchgroup.com/portfolio. And of course, if you just want to read our newsletter, it's free. Just go to Wealth Research Group to the homepage and subscribe.
Fantastic. All right. Thank you, Lior.
Absolutely.
Appreciate it. Okay, so that does it for this one. Let us know what you think. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.